Where are you seeing emerging strength now that gives you optimism?
Well, I don't know that I'd call it optimism. And the reason I do that is I think I have a massive edge over the average guy who's just looking at it from an index and sector standpoint, that this is not a market for a novice. You know.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today we're sitting down with a frequent guest on my programs, Joe Rabil of Rabil Stock Research. Joe's a fellow StockCharts contributor. He describes his process as trend following on steroids. And what he's about to describe to you reminds me very much of my experiences working with top technical analysts at big money management firms in the Northeast. Great take on the current market environment, great discussion about the relationship of the benchmarks to the breadth and momentum conditions that we're observing, and some great insights on which areas we're seeing emerging strength here in Q1 of 2026. Please enjoy this interview with Joe Rabil of Rabil Stock Research. Excited to be sitting down again with Joe Rabil of Rabil Stock Research. Joe, Happy New Year. Good to see you again.
Good to see you too, Dave.
So the markets, and thanks for joining me here on Black Tuesday, I guess.
Yeah.
We'll call it. Market's selling off aggressively, I think, as the market gods saw that you and I were going to talk today. So making it interesting for us, which is awesome.
Yeah.
But, obviously a lot of transition in the markets from Q4, how the, sort of October, November, December played out, and now what we're seeing in January. I think everyone's kind of struggling to kind of find their footing and figure out what emerges through this sort of initial period. Let's start high level if we could. I want to talk a little bit just about the broad market environment, and then we'll get a little bit into your process, what kind of tools you're using, and let's talk about some specific charts along the way. But start us out big picture. The S&P, obviously, at or near new all-time highs, but I feel like we've been saying that for a couple months now. We're sort of unable to get above that 7,000 level. And now to start the week here, shortened holiday week, we're pulling back a bit. Where's your head at in terms of the current broad market conditions, and what are the key things you're looking at here?
Yeah, I've found it a little bit, I don't know, annoying almost the last 2-3 months, because I do my reports, and, my Monday report has been like, on repeat, you know what I mean? We've had the exact same environment now for about 2 or 3 months, and that's essentially a market that is in an uptrend but has zero momentum. We had no momentum on the weekly chart, and then we turned to have no momentum on the daily chart, and it's just it makes a new high and then it gives back, and it's just not the type of environment from an index level. Right now, I'm talking about from on the indexes, not necessarily a stock by stock basis, and we'll get into that, I think, as we go further. But the way I see it is the index, which is weighted down right now by these big names that are correcting, and every time it tries to go to a new high, it just can't get. And it's not a true breakout. To me, a true breakout has to have momentum confirmation, and we really haven't had that. At least based on the way I look at the world, I use ADX for that. And it just won't confirm. It hasn't confirmed on a weekly chart for the whole move. And where it's really bothered me again has been really the last 3 months, where it makes a small progression and then gives back.
Really interesting. I'm going to go to a chart of the S&P here, because you'd mentioned the lack of momentum support, and totally agree, right? If you look at the October, this is my chart, obviously, but the October peak, we're hitting 6,900 plus. The RSI is almost overbought. And then every attempt to get to 7,000, the momentum's been weaker and weaker. Right? We're having less momentum. The ADX is the indicator we're showing at the bottom. The ADX is at fairly lowest levels it's been in the last 12 months or so. So tell me a little bit more, because ADX, you're one of the people that I talk to that uses that indicator pretty regularly. What does it mean to you when the S&P on the surface appears to be in an uptrend, but the ADX line is so low? What does that mean in terms of the trend?
So what the ADX does, there's 3 lines associated with the ADX. One is the buyer's line, which is just basically tells us how strong the buyers are. Yeah. And then there's a seller's line, and that's negative DI. And that essentially tells us how strong the sellers are. And what's happened here is, and this is what's sort of typical, is you can trend to the upside and not have a lot of buying strength, not having that much buying strength. And that can cause it to keep going up. It's not going to go down until we see sellers. So
Yeah.
the sellers are really what we're looking for and been waiting for. I've been saying this for a while to my subscribers here, just like, okay, we know we're in an environment, again, at the index level that is not all that great. It's not that strong because the buyers are not that strong. And it's been that way for a while. The good news is the volatility has not been that bad recently.
Yeah.
And so it's allowed you to maybe play around a little bit. But again, if you don't think about the indexes and you look at it from a bottom up standpoint, there's been a lot of opportunities, and it's just away from where everyone's been looking for the last few years, which is tech. If you looked at everywhere but tech, you could probably find some ideas, and maybe you've even done pretty well. And you might even think, wow, the market looks great. I mean, you'd be thinking that based on the way some of these stocks have been trading. It's been amazing.
Yeah.
So, yeah, I mean, I think, the market, if it turns into a little bit of like a dip like it did last year, beginning of last year,
Yeah.
it's going to affect all stocks, right?
Right.
But what we want to do in this type of environment, if it turns into something like that, you need to go and look at what stocks are leading during the decline, right? We're looking at relative strength is the most important thing to look at, especially when we're in a declining phase. If we get into a market where it slides away to the downside, you look and see which of the stocks had good technical characteristics before the decline, and then were resistant to going down. And that would be the approach that I'd be looking at if this thing does turn into something that's a little bit more, more like a move down to 6,200 or something like that, which I would say would be like a bigger target for me if it got ugly.
Around 6,200, you said?
Yeah. That would be a pretty deep sell-off as far as I'm concerned, based on how everything looks to me. I don't know that we will get that,
Yeah.
but
Yeah.
it all, when you get into this tariff talk, you just never know. I mean,
And it's the uncertainty, I think, that gets us more than anything, right? I mean, it's just the instability, and we're already seeing that just this week. The market reacting to news over the weekend. It's obviously happening quite rapid. Who knows what'll happen between now and the end of the trading day? Even so if you think about 2025, the quote that I threw around a number of times as that bull market progressed was the don't confuse brains with the bull market, or one of the everyone's a genius in a bull market, right? I mean, in some ways, those trends are so easy because it feels like you can get away with so much because things are just kind of generally working. Do you feel that changing here so far? And I guess is one question. And if the quote from last year was "Don't confuse brains with the bull market," like what's the quote that people should be keeping in mind, or a general market maxim that would help them navigate what you're expecting, at the beginning of 2026?
that this is not a market for a novice. I mean, seriously,
Yeah.
you've got to do your work in here if you're going to see what's going to work, what's working.
Yeah.
The problem I've had is my positive list has dropped down a little bit. And the reason is that some of these stocks are so extended on the upside.
Yeah.
So to me, that's a negative. Like, I don't want to be recommending something that's really stretched away from all of its moving averages and everything, but that's not negative. That's very bullish, especially in an environment last year where the average stock underperformed the market. And now I think that this year could be a year where the average stock does better than the market.
Right. And we've seen that, I guess, to your point, we've seen that with the fact that breadth conditions remain remarkably strong. You alluded to the fact that there are a lot of things outside of tech that look quite good and have continued to break out, right? And even into the new year. And we'll try to highlight some of those in a little bit. I think that's a point well taken. So I think a lot of people, probably sitting on some pretty decent gains after 2025. From my read, people are a bit nervous about what a downturn could do to those gains, and you don't want to give them back. So I guess the real question, how would you differentiate? Let's say we do get some sort of corrective move here in the first quarter. What kind of tools or approaches would you use to differentiate kind of that garden variety pullback, similar to what we had a number of times in the latter half of last year, versus a more significant decline, like a February, March of 2025 decline that you end up, generally want to be staying away from? How do you differentiate kind of that short-term, very viable pullback to a much deeper, more painful pullback?
Well, you don't know it,
Yeah.
right? I mean, you can't predict it, I should say.
Yeah.
You
Yeah.
couldn't know it at the time, but if you get into this prediction game, you really, to me, it's just not the right way to go. I like to look at my indicators and go through them, and if we get too bearish, so sentiment becomes a kind of a little bit, it's a secondary indicator for me, right?
Yeah.
But it becomes more important when we're in an environment where the market starts dropping. I want to get those guys. I want those bulls to just evaporate and see some real, big jump in the bears. And then I can start to look for signs of climax in price action, especially out around the key levels. So you define where the key levels are. You want to undercut them. I love it when we just barely go through them and get a lot of bearishness. I mean, you go back and look at some of the greatest turns and like the 2020 turn. Oh my God, you undercut a major low. Everybody in the world was bearish. And then it turns on dime and everybody stayed bearish on the way back up. Now, I was cautious on the way back up until it got through the 50% retracement of the last decline. And then I knew that this was not just your ordinary bounce. And so, but the point is that I think sentiment plays a little bit bigger role when we get into that type of a drop. The bulls got a little, we have too much bullishness right now. So we got to see that switch. It doesn't have to turn bearish. Like we don't have to have more bears than bulls, but we need to get that bull number down and have some of the bears turn up and have it shrink some. I use the investors intelligence number. It's around 41. I'd love to see it down like in the low 20s, high teens or something like that. I feel really good about it. In a bull market, you just need a drop. A 20 to 25% drop is good enough. In a bear market, it's got to flip to negative before you want to do any real serious buying. But I would say, again, you just have to put together, there's three things. I think you're looking for price climax and you're looking at the key levels and you're looking at sentiment. So that's kind of how I handle it. Now I'm looking at a bunch of individual stocks too. All right. I go through thousands of charts. And the reason I do that is I think I have a massive edge over the average guy who's just looking at it from an index and sector standpoint. When you just look at the sectors and you just look at the sector charts and you just look at the index charts, you're missing out on a pretty big advantage, I think, because the leading stocks are always going to turn up quicker. The leading stocks in a sector or an industry group are going to turn up faster than the index will. So just as an example, let's say you're looking at the XLB, right? And the gold's been doing all this stuff, but XLB just recently kind of broke out. Well, the reason is, and it's been happening for a while, is you've got stocks, you've got specialty chemicals, you've got aluminum, you got steel, you got all these different areas that have kicked in, and they did that well in advance of the index actually turning up, which just happened. And most of those stocks are actually overbought. You look at copper. I mean, copper's gone crazy here over the last few months. So you have to look at the individual stocks. It's more work, but it's a massive advantage. It's just a huge advantage. So that's kind of, I always tell everyone I'm a bottom up guy. And that's my reasoning. I did it at my old firm. We did that and always felt like we had a 2 to 3 week advantage over the guy that wasn't looking at the individual names.
No, that's that's a really good point, Joe. And I know, I mean, in your work, you work with a lot of institutional investors, and you have for some time. And I think that my impression that probably comes from a lot of that work. I know at my time at Fidelity, it was very much a bottom up exercise, and you often felt the shift before the S&P or the NASDAQ would start to make this change. You would just feel things start to move around. And then it was like the indexes eventually recognized or acknowledged the weight of this rotation that you were already observing. So I think that is a really good advice. And I found with individual investors, they tend to undervalue the importance of looking at individual stocks because it, as you said, it's a lot of work, but arguably if it gets you to a really good place, probably super worth it. So
Yeah.
with that in mind, your bottom up focus, I think, as you mentioned, a lot of people are focused on the larger picture, the S&P appearing vulnerable, this lack of follow through. So what sort of rotation have you seen? We've seen rotation away from some of the leading growth names into other areas. Where are you seeing emerging strength now that gives you optimism?
Well, I don't know that I'd call it optimism.
Okay.
You know what I mean?
I shouldn't put words in your mouth with my
No, I
question.
just mean,
That's a horrible
I'm not
interview
sure what to
question.
expect at the index level.
Yeah.
There's some risk there. Just again, we've got a very top heavy, top 7 name, top 10 names. It's never been like this where tech has been 30 whatever percent like it is. It's crazy.
Yeah.
So to unravel that or change that, it's still, there's some risk. And I still recommend hedging. I mean, I don't hedge all the time. I wait for certain things to be in place. And if that's the case, then I'm going to hedge my long side. But the answer to your question, we've got areas like I've already mentioned in basic materials that's pretty fresh.
Yep.
I would say in the last 3 to 4 months, we've started to see a lot of dynamic moves outside of gold. I mean, gold's just been going straight up, gold and silver, but I'm talking about outside of that. It's been improvement. There's also been a lot of improvement in energy and is sneaky turning here. And maybe not so sneaky right now, but because I think it's the only index it's only the sector that's up today.
I think
But
that's right.
I'm just saying, like, you go through the individual stocks and you're starting to see pretty nice improvement, big breakout in Exxon, but underneath the surface, there is improvement going on. And then I would say healthcare, starting late last year, we started to see some turns develop, and it's just continued. And it's starting to get a little bit, we're starting to see more stocks do some of the right things and follow through on their breakouts and that kind of thing. And then industrials, when I looked at industrials this weekend, they had an incredible week, but it was almost all of it was aerospace. It was defense.
Aerospace defense names. Yeah.
Yeah.
Yep.
So, I mean, I don't want to, hang my head on that. You know what I mean? But they are going up, and there'll probably be some pretty good names. I kind of like Boeing. In the fact that it's got this massive base. It's a huge base, and it hasn't even gotten started yet. And I think it's a pretty big turnaround story from what I've heard from some people. So I think it's the type of thing where I'd rather not chase something that's been going up for 3 years and is extended and is showing strength. That's relative strength, but it's not my kind of. I want relative strength that's newborn, emerging. Relative strength is really what I'm a fan of.
It's very kind of you, Joe, to throw out a Seattle-based company, Boeing. We could talk about Starbucks too. That's an improving one. We don't have to talk about Amazon. That's a little less ideal at the moment, but no, to your point, I think you're right. And going back to your comment about bottom-up analysis, that's one thing I learned earlier in my career when I actually started doing that regularly. You realize with the sector like industrials, some of the diverse businesses, right? We got like the big diversified kind of conglomerate 3M kind of things. You've got, heavy machinery names. You've got transportation names. You've got aerospace defense. They're all very different in a lot of ways. And really appreciating that it's not just the sector, but there's a lot of very diverse groups in there, I think is a great lesson you learn very quickly when you start to look at at a bottom up kind of approach.
Yeah. And go ahead. I don't want to interrupt you.
No, please.
Well, what I was going to say is that what I recommend people do is start out with on a weekend, right? And you're too busy during the week, you can't do it. But you take 150 or 200 stocks, the biggest names, just sort of by market cap, and then cut that list off at however many names you think you can go through over the weekend. And a lot of guys usually are picking out 200, and you sort it by your sector, right? And then do a secondary sort by your industry group if you can, and just have that list and just go through it that way. And you're going to learn a lot. I think you're going to see things. It's not necessarily a buy list. It's more of giving you a feel for what's going on. You have to have some discipline that you go through that gives you a better feel for what the market's doing. I think that's what I would recommend.
Yeah, no, that's a really, and I was going to ask you exactly how you would suggest going through that, Joe. And what you just said makes it reminds me of some of the best technical analysts I've worked with. As much as they were great at analyzing charts, which they were, and as much as they had like a good sixth sense about the markets, which they seem to, I feel like their biggest superpower was just consistent routines and just looking at the same set of charts the same way at the same table, and they just didn't miss a beat. And as a result, it was almost impossible for them to miss shifts because they would see all of a sudden a couple of days, okay, wait, this was here and now it's over here and these were over here. And just that consistency is what adds so much to that, right? It's not about doing it
Yeah,
one day, it's doing it over time.
there's no doubt. And
Yeah.
one of the negatives of it, and you got to be careful if you get good at it, is you're too early. You see it happening so far in advance that
Yeah.
sometimes you're like, oh, I know this is happening, and you end up being right, but
Yeah.
you're seeing it so far in advance. It takes a little time to get through the stage where it's really ready to kick in.
Yeah.
So it's a huge advantage from that standpoint, but you got to
Yeah.
be a little bit careful about go diving in something that you see is starting to turn, but it is a little bit on the early side. But yeah, I
Yeah.
think it's a great. I really do. You caught me on a bad day. I only went through like 1,200 stocks this morning. I mean, so I'm just a
No
big
excuses,
believer.
Joe. Okay, come on.
I'm just a big believer. You gotta do the work. And
Yeah. Yeah.
the more stocks you see, the better you're gonna get. The more charts you look at, the better
Yeah.
you're gonna get at being a technician.
I
So
think unfortunately we're in an area an era as a society where people are looking for hacks and looking for
yeah.
like the quick way to do it. And this is one of those where I'm a big, and our predecessors used to complain to me about, you need to update charts by hand. And if you don't do that, you're missing out. So hopefully people, the newer analysts and investors watching will take this to heart and start to go through it. You'd mentioned energy, and 100% right? Names like ExxonMobil have already been in pretty good runs, but other stocks in that sector kind of mix, right? I mean, and it depends on what part of that kind of energy complex you're in, I guess. But I think one reason why people have been avoiding energy is because crude oil prices have remained relatively low. So as a bottom up stock picker, how do you think about improving charts in a sector like energy versus something like, hold on, crude oil prices aren't really confirming that? Is that the kind of thing that would prevent you from taking action on a name, or is that just more of a sort of a macro thing? But if the chart's working, move on. How do you kind of reconcile that sort of issue?
Yeah, it's a great question. I just uh energy stocks tend to lead the lead
Mm,
crude.
yeah,
And I think you ask a lot of guys out there, they think it's the other way around. And I'm
yeah,
telling you, I've been doing this long enough by, bottom up, that I'm pretty confident that it's the other way around. But think about this. You've got the price of crude acting terrible, and these
mhm,
stocks are not budging. They're not only budging, they're going up.
yeah.
So to me, it's like a beach ball being submerged under the ocean, right? It's being pressed down by crude, and then when crude goes up a little bit, these things are going to really pop. I think that's what's happening.
I love the beach ball analogy. That's a great one. I'll keep that one, and I will give you full credit for it, Joe. It's a great one. But that's exactly what it's felt like, right? With a lot of these names, they feel like they've been basing or they've been just been consolidating for so long that all of a sudden they're just starting to explode to the upside. And again, another benefit of the routines you mentioned, a lot of times with a sector like energy, it's been underperforming for so long. Probably with healthcare, a similar thing, right? It's been such a dog for so long, it actually just starts to work. And if you just keep showing up and look for the charts to start working, you're going to be way earlier than a lot of people that just aren't. They just sort of wrote it off, and they're going to be late no matter what.
Yeah.
I
Yeah.
think that's a great point.
Yeah.
What just to finish up here, I mean, as the high level indexes appear vulnerable, as you're starting to see opportunities in different areas, but a lot of stocks, to your point, have already had really good runs. Even stocks like Alphabet have had remarkable runs. A lot of these were overbought last week. A lot of them starting to pull back here to start the new week. What's your biggest kind of risk? What's that one thing that keeps you up at night, if that is a way to describe it? Or what do you think is the biggest area of concern, what we should be focusing on as investors here to start the year?
Well, I think my personal, what I've been kind of drumbeating my subscribers is stay on the stock level,
Yeah.
and you should and it should lead you in the right place. So right now, leading stocks that have started to turn up and emerge on a relative strength basis are overbought. And if the market corrects, it could pull them back, but you got to be disciplined. If they pull back the wrong way and they end up not setting up and not triggering, then you're not going to buy, right? I mean, so I just, the program I try and follow is and teach is you've got strength to the upside, but then you have a pullback against that. That is the entry that you're looking for. But if that pullback happens the wrong way, then you don't buy it. So you don't buy it on the way up because you're waiting for signs. There's just particular things that got to take place in the stock on the way up and then on the way down. And if those things happen and then you have a trigger in place, then you buy. And if you do that and you risk 1% of your equity, right? And you put hedges against your longer term holdings when the market looks vulnerable, you should be able to make it through any kind of market environment. I mean, I know I'm making it sound really easy, but it's not. But it's a lot. It's more simple, right? Than you might think. If you follow a plan, you have a written plan, you follow it. And I call my approach, trend following on steroids. I'm looking for. I'm not just buying any breakout. That's what a typical trend follower just take a list of stocks and say, I'm going to buy the breakout. I have to have certain characteristics in that breakout, usually associated with ADX. And if it has that, I know that the chances of that turning into a big win if it breaks out are probably pretty substantial. So I've got a pretty high likelihood. In other words, I have an improved chance of it turning into a big move. So if we do that, and then we, again, follow the discipline of not putting all your money in one stock, right? And don't, risk everything. I would say 1%, you can go up to 2%. If you're 3%, you're going to have a hard time sleeping at night, right? If you're risking 3% equity on every stock. But if you stick at 1.5%, I think you're going to be fine. And I don't mean risking 1.5% of the position. That's 1.5% to your stop, right?
Right.
So as long as you stick to that kind of a plan and you don't go crazy and buy 10 energy stocks in the same week, I think you can make it through any environment. That's why I'd rather follow a bottom-up plan than to be overly focused on the market. Now, I put out 3 reports a week on the S&P. So it's what everybody wants, right? I mean, it really is. But the reality is that you use that as a benchmark as to how aggressive you want to be and how quickly you want to be jumping in, and what the sentiment's telling you. Okay, well, the sentiment's telling me everything's overdone on the downside. I might want to go in my 401k and buy some ETFs that, index funds or stuff like that in that situation, as opposed to maybe diving into stocks. So I think that if you said, what keeps you up at night, I would say it would be if I didn't follow my discipline. That would be just diving in, and you're going to do a certain amount of that no matter what. But if you can keep that to a minimum, I think you're going to be okay, at least in my world.
Yeah. Right. Yeah. Life gets in the way, but I think one great takeaway from this conversation is sticking with a good, consistent routine of following names. And Joe, what you're describing reminds me so much of the processes we used at Fidelity in the technical research team there, which is a tried and true approach of just a bottom-up analysis and just focusing on trends. And I love that idea of validating breakouts based on the characteristics. I think that's a really good takeaway as well. You had mentioned, Joe, the relationship between multiple timeframes. There's this great book I've read called Invest Like a Pro by Joe Rabil. You should check it out at some point. But just to finish off, tell us a little bit more about, again, I think a lot of times, certainly investors just getting started tend to put their blinders on, and they analyze one chart and that's kind of it. can you talk about sort of if we do start to get a pullback in a name that you're holding, how do you think about multiple timeframes? What does that mean in your ability to think about risk versus reward in a pullback scenario?
Pull back in something I'm holding or something I want to buy.
Yeah, like something you're holding and you start to get a pullback. How would you differentiate or use multiple timeframes to kind of understand the I guess the nature of that pullback?
Yeah. So, I mean, if you're looking at a stock and you're trading it for like the next month or something like that, then
Yeah.
you've got to be focused more on the daily chart.
Yep.
And the risk that I recommend is using average true range of 2 times the average true range as a way of kind of starting the position at and that's your stop loss. And then
Yeah.
it's multiples of that that tell you about your targets and where you're placing your stop. So I like to do that. But your question is a good one. If it all depends on what you're trying to accomplish. If you're trying to get in and
Mm,
get out over the course of like a couple weeks to a couple months, then you need the daily time frame for that. If you're
yeah.
trying to be in for a couple months to a couple years, then you got to use the weekly chart for that. And you have to use the associated average true range for that and to help you kind of withstand the the drops that are going to happen, especially like today. I mean, we're getting a big drop. If
Yeah.
you've got everything off of trading off of a daily chart and you think you're going to be in it long term, there's just no way. You're going to get stopped out all the time.
Yeah.
So you've got to be able to take a smaller position, give it a little bit more room, and then just hold a few more positions, right? If you want to be longer term, it's not. So that's the way to handle it. You have the size of the position smaller because you have a wider stop, and
Mm, yeah.
and by doing that, you give yourself the ability to live through, even 5 to 10% corrections. If you're in a good stock, it's not going to drop as much as the market.
Right.
And so if you're in a bad one, you get stopped out. Maybe that's a good thing, right? You move on and go, but you just have to have your risk parameters in place. And again, you do have to differentiate what you're trying to accomplish, what your targets are. And then you use either a daily or a weekly, at least in my world, that's how I would go about doing it.
No, that's really well said, Joe. And I've often found there's sometimes a mismatch between what someone thinks they're trying to do and the charts and the tools they're using, and bringing those in better alignment, I think, is really good. A really good reminder. Thanks for that, Joe. This is a pleasure as always. Thanks for some market wisdom, some market awareness for all of us. We appreciate it a great deal. We'll put a link to your book, which I think is a great way to just think about how you think about the markets and different indicators. And your website, rabelstockresearch.com, I think.
Yes. Yep. That's
Awesome.
it.
We'll put links to both of those so people can check it out. But thanks for coming on the
Sounds good.
show. Thanks for what you're doing as a Stock Charts contributor. I definitely enjoy reading your content over there as well. And we'll look forward to having you again on soon.
Dave, it's always fun. I just always have a great time talking with you. So I appreciate you having me on.
Tell you what, I really appreciated that discussion with Joe Rabil again. I feel like he encapsulated the role of the buy-side technical analyst, which is a process of stock picking. It's having a good awareness of the big picture, a good awareness of the overall market structure, but focusing on individual stock opportunities. Having said that, we talked about some interesting, compelling, emerging strength in areas like energy, in materials outside of precious metals. We talked about, specialty chemicals in other areas of the materials sector, even some financials and healthcare. We also talked about the big picture, and I thought Joe's take on the overall environment was spot on. We've certainly been observing in our work that difference between Q4, which is the market moving higher on stronger momentum, to December, and really that was more Q3 into Q4. You had those new highs in like July, August, September on stronger momentum. But if you go to the fourth quarter, October, November, December, those new highs were marked by weaker momentum. Now, Joe uses an indicator called ADX. That's an indicator created by Wells Wilder, same guy that created RSI, which I use often. The parabolic systems are part of that, of his work as well. And Wells Wilder created this idea of directional movement. He created the directional movement indicators, and a derivation of those indicators are the average directional movement, or the ADX line. Joe, better than anyone, explains how you can use the ADX to measure the strength of the trend. And I think his point was well described, which is stronger ADX in the third quarter of last year, weaker ADX in the fourth quarter, and now into the beginning of 2026. We've talked about that parallel transition from strong momentum to weak momentum through the lens of RSI, which is sort of our go-to momentum indicator. Same thing, right? There's a difference between the market making new highs in overbought conditions and the market trying to make new highs with weaker momentum, which is what we've observed here in the last couple months. Having said that, it's always a good time to own good charts. That's how I sign off pretty much everything that I do in a video format. And I think this discussion with Joe Rabil really, celebrated that reality. Regardless of what you think about the S&P and the NASDAQ, regardless of what you think about geopolitical issues or potential macro headwinds or tailwinds, there are always compelling charts out there. And I'm not struggling to find charts that look encouraging, that are actually emerging from impressive bases with some potential upside to speak of. It's just not in the AI-fueled frenzy kind of names that we observed in much of 2025. So the way you find those names, as Joe described, is having a consistent process of reviewing the charts and focusing on new areas of strength. Kudos to Joe Rabil for so eloquently putting the benefits of bottom-up stock picking using technical analysis and sharing some great tips and tricks along the way. As we mentioned, his book, Invest Like a Pro, is a great read, pretty easy to get through, and really describes how he uses some of those indicators that we just touched on here in today's episode. And you can find more information about Joe and his work at rabilstockresearch.com. By the way, if you want to learn more about how to analyze the markets using behavioral and technical analysis tools, if you want to develop better routines for identifying those next big breakouts, our Market Misbehavior Premium members may be a great opportunity for you to upgrade, supercharge. I mashed those up into one word. If you want to upgrade and supercharge, or as we just called supergrade or upcharge your investment process, check out our Market Misbehavior Premium memberships at marketmisbehavior.com/premium. 3 great benefits of the premium membership. First off, we'll teach you how to use technical analysis. We'll teach you what's happening between your ears. That's called behavioral finance. And we'll talk to you about the routines that we use to analyze the markets every single trading day. You also have access to our members-only reports like our monthly chart review, our weekly flight plan, our 2026 market outlook, which went out earlier this month only for our premium members. Finally, we have a member community where you can ask questions, you can learn from other like-minded investors, and you can get some great guidance as we navigate these markets together. All of that is included in our premium memberships. You can find more info at marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for today. I'm Dave Keller with Market Misbehavior, here to remind you, as always, it's always a good time to own good charts. Take care, folks.